Okay. Mariana Danilovich, I ran Hollywood Portfolio, which is an accelerator for digital media companies, and this summer I launched Infium, which is an accelerator for disruptive tech. So it includes blockchain, AI, AR, VR, DLT, quantum computing, and other disruptive tech. And the reason we launched that is that Fortune 500 companies will be very disrupted in the next 10 years. About half of them are not going to be on that list within 10 years' time. So we thought this is a perfect time to plug them into companies like the ones we have on the panel here, who have terrific, very experienced management teams, have had successes in the past, and have gone through a very challenging fundraising market in the last couple of years for all of these technologies, and definitely for blockchain. So that's what I do, and I'd like to now introduce some of the panelists. You'll see that they're involved with different areas of investment and have also been raising investment in different capacities in the space. So Ewan McDonald is with DreamView Studios, and he spent a few years in the CGI space. So can you tell us a little bit about it?
Sure. So Ewan McDonald, CEO and co-founder of DreamView Studios. My background is predominantly in visual effects and CGI for games. I worked at Industrial Light and Magic for 11 years and everything from Harry Potter, Star Wars, Jurassic Park franchises, doing kind of leading edge at the time. This is from the mid-90s until the mid-noughties, essentially doing everything from dinosaurs, dementors, and dragons. But in the last 10 years, I've been doing like a series of startups focusing on the cross-platform social media space, mobile games, augmented reality and virtual reality. The company I had before this, which is Holler Media, helped build 360 VR cameras, which we took under the set of Transformers 5. Michael Bay's company, 451 Media, was an investor, and we got some behind-the-scenes footage, which was then used for like marketing experiences. This latest company, DreamView Studios, is focusing on the CGI e-commerce space, creating like CGI 3D content for e-commerce, everything from like augmented reality CGI products that go into like Amazon.com and their app and kind of things like that. So that's my background.
Very exciting. And then Deb Sellers is the co-founder of Butterfly, which is a next-generation influencer network using blockchain and some other technologies.
Yes, hi, how are you? My background has been in the technology sector my entire career, and I have focused in on global sales and marketing initiatives, and also have been on the capital raising teams of multiple startups. And most recently, I am at Butterfly, where we have created new technology, which is AI-powered social data that provides actionable intelligence for brands so that they can scale their global marketing initiatives. So it's been kind of a fun adventure, and we have been in capital raising. We've been successful in that. We can talk a little bit more about that in this session. Sessions.
And then Ben Tsai is with Wave Financial, and he was with DNA before that, so he's kind of made rounds like I have of the top of blockchain, and he'll tell you a little bit more about what he's working on in the space.
Yeah, hi, I'm with Wave Financial. So, in terms of fundraising, and I guess that's the discussion here, I've been on both sides, or kind of various different sides of this. So, Wave Financial is an asset managing firm. So, as one function of an asset manager, we have to raise money for our funds. And, as a second function, we're also deploying capital into the VC space. So kind of sat on both sides of that. And at the end of the day, we're also a startup, so we've raised for our own startup. And just to kind of add to that list of things that we do with raising money, I'm also the CFO and the co-founder of LA Blockchain Lab, which is a nonprofit that connects the Southern California universities with the government in the blockchain space. So we've had to raise money for the nonprofit also. So that's kind of 4 different angles on that discussion.
From every perspective of fundraising. And then Helen Territori is bringing a new concept to town, which I was really excited about. I was hoping this would happen for like 20 years, and here you are, which is called The Rattle, and she'll tell you all about it.
Sure. So I started out originally in the music space, and through a series of unfortunate events became an investment banker for about 10 years, mostly on starting out in large cap tech M&A and moving backwards all the way to emerging technologies, VC, fundraising, all that kind of jazz. But all the time I was looking at the music industry and thinking, well, why is the deal so bad in music? And I'm negotiating really great bespoke deals on the VC side for emerging technologies. So the Rattle is essentially a way to... it's a series of co-working incubator accelerator spaces that work specifically on finding new business models for the music industry. Blockchain's a big part of that. We work with a lot of emerging technologies across AI and immersive technologies as well, to find new ways for musicians to become founders of their own companies rather than employees of major labels.
And that's what I think is very interesting, because Max Brody, founder of Sen, has a very similar background to Helen's, but he has actually applied it to something that's, I would say, like one of my favorite blockchain companies. That's an Instagram, YouTube, and Kickstarter killer, maybe.
Okay. So, I'm Max. I run a company called Cent. We're one of the most popular networks on Ethereum right now. And how it works is essentially we've pioneered this idea of essentially fans being able to invest in creators in a way, but it's really simple. So essentially you can, if a fan finds a creator or finds some sort of digital content producer that they like and they're on the platform, we do this process called seeding, which we're about to update to a new version called spotting. But essentially what happens is you can give money, either to a single post or recurrently each month to the creator, and what you get is basically, like, if you're an early person to give money to the creator, then you get a proportion of everyone who comes after you who gives money to the creator. And so you're sort of designed to, or incentivized to, find and then give to early stage creators, and then you'll benefit financially, which sort of takes a very similar mentality to investors in startups when they're trying to look for value early on. But we sort of simplified the math, simplified the structure, and applied that to content and artists, and it seems to work. And
It's great. And some people in third world countries have quit their jobs and are now solely employed by Cent, which is really great.
Yeah, that's really our ultimate goal, is to sort of be a new type of income for sort of the new world.
So that's what's really exciting for me, being in the venture space for digital media for a very long time, a couple of decades, is to see that there's always such dichotomy between funding of ventures and then funding of creative talent. And you guys all are in the business of kind of solving the problem for both, using your ventures. So maybe let's start with Helen and just maybe talk about, why did the Rattle first start, and what were some really stark differences between funding of talent and talent's businesses versus funding a tech venture, which we're all used to.
Sure. I hope I'm not going to dispel any myths about the music industry, but essentially the reason the Rattle exists is because the way the music deal works, post-Napster, is very focused on monetizing the back catalogue. I don't know if anyone's bought the 17th remastering of the White Album. It's not very geared up to invest in new talent, and you can kind of see that on the festival lineups around the world. Even the last couple of years have been a bit better, but until fairly recently, I was going to Coachella and seeing AC/DC and Red Hot Chili Peppers, and 6-year-old dudes that are millionaires, they don't have a lot to say to kind of youth culture and the next generation. And like I said, the reason that is because the mechanism which invested in new voices and new talent has kind of broken down. So what we're trying to do is decouple this idea that if you put money into a creative, you have creative control over what they produce, because that essentially means homogenization and a reversion to what's gone before. It's never been the case in startups that if you invest early stage in a company, you get the right to decide what they make and do. So all we're really doing is applying that logic to creatives and saying, if you give them the tools to become entrepreneurial and have a founder mindset, you can trust them with money to make good stuff.
Yeah.
Does that make sense?
Yeah, you're trying to help them build a business, which I thought always, the creatives are creative, but they can be creative and business people and everything, and implementers at the same time, and you're helping them to get there. So.
Exactly. Traditionally, the creators have been kept out of the business conversation because certain people were incentivized to keep them out of the room. I have talked to endless artists who wanted to be involved in negotiating their own contracts, and they weren't allowed to because they were creative and it was their job to go in the studio and make beautiful things. It was almost a taboo for an artist to say, no, I'm interested in business, I'm interested in the money side, and I want to see the contracts. So we're trying to reverse that and turn the 80-20 deal, which is the traditional 360 record deal, on its head.
Yeah, and I think, Max, you wanted to say something about that too, in terms of using the platforms now to enhance that as well.
Yeah, I think for a while the sort of legacy structures of the world will still exist and will to some degree innovate, but I sort of feel like I'm very much of sort of the next thing, which is just completely sidestepping that whole structure. And it's if people can get a lot of fans, if people can get millions of people to like whatever it is they do, there's a lot of different ways to turn that into plenty of income for them. And I think what really excites me are things that are really connecting people directly to the people that really love them in a way that's intuitive and financial. And I think for a while we needed all these other structures to exist because essentially we didn't have the internet, we didn't have computers, we didn't have a way of distribution, we didn't have, everyone has a recording studio and their laptop now. It's way easier to get up and get running. You don't need huge amounts of investment early on from a studio or from a label. And so I definitely think it'll be interesting to see how the legacy structures deal with interacting with sort of incumbent models or up-and-coming models that are challenging them, because I think there's going to be some sort of, there already has been some standoffs, but I'm curious to see how that evolves over the next few years.
And the promise of blockchain, one of the things that attracted me to it was this whole idea that you can allow creatives to have a bigger piece of that pie without all the intermediaries. So Butterfly was kind of formed on that premise that, basically all the Instagram celebrities and bloggers and people who are influencers in their own area are not really connecting to the revenue in the most optimal way. So I want to kind of address what you guys did there.
Yeah, so one of the things that we did is in building our technology is to build this huge social database and apply machine learning to that database in order for it to be smarter and connect the right influencers with the right brands. And what does that mean? That means connecting the not just the influencer to the brand, but the audience affinity to the brand, so that they can get better engagements, better return on investments. And in doing so, that was the premise of starting Butterfly and being able to do this, doing campaigns on a global basis. Because one of the biggest challenges is that a lot of these brands have a difficult time in connecting with the various different influencers around the globe if they want to do a global campaign. And so the blockchain allows us to do that, allows us to contract with the various different folks effortlessly, and the influencers to get paid immediately. And it also shows what their worth is, because you can actually verify their engagement and everything else that goes with it. So it's a really good way for the brands to get a good return on their investment. It's a really good opportunity for the influencers to be able to get more opportunities where they can actually excel, because a lot of these influencers, they don't want to just do a one-time campaign. They want to be brand ambassadors. They want to work with these brands on a regular basis. And so with the technology that we have, we find that that's very useful and helps solve the problems on both sides, both the influencer and the brand.
It shows the ROI.
That's right.
So with DreamView Studios, that was somewhat of an idea as well, is to create work for, almost like a gig economy for many creatives.
Yeah, I mean, we were the size of the market in terms of the 3D commerce, and essentially creating CGI products for every product on the planet is a rather tall order. And one of the things which we identify is like rather than just continue to scale our own services, which is the DreamView Studios part of the business, we need to kind of manage the distribution and manage the actual assets themselves in the distribution, which is essentially our platform, which is dreamview.io. And that's essentially something which we're offering to all of the businesses that we're working with and the manufacturers, both the receivers, which is the e-tailers like Amazon. They don't actually create a lot of their own products. They essentially get that from a lot of manufacturers. And with the CGI, before they were just getting images and it's like send me a photo of such and such, but then they required like a CGI version so that companies like Amazon Wayfair can create their own product representations and lifestyles, which is also to do with like CEO and discovery of those products. But in addition to that was the increasing demand for essentially creating augmented reality versions. And now they're basically passing that buck to the manufacturers saying, hey, we need 3D assets and we need high quality photoreal, we need like augmented reality versions as well. And most manufacturers are saying we've got no idea how to produce 3D assets. How do we get this done? So that was an opportunity for us to essentially go in with production services, which is the studio part of the business, and then DreamView.io, which is part of the like how do we actually manage this and how do we actually get the evolving requirements back to like companies like Amazon and Wayfair. And doing so within a platform allows us to essentially like manage both the assets and the relationships to the assets, including like license management, digital rights management, etc., which is another good use of the blockchain. So we're doing proof of existence on the blockchain, as well as like smart contracts between essentially who's actually creating product within this ecosystem, and then ultimately a marketplace as well for transactions to happen within this ecosystem. So it's something which we're developing right now, and we've partnered with a company called Suku.world, and they're doing physical provenance on the blockchain. And essentially that's like, where does your meat come from? Where does essentially a product come from? So it's a great synergy because they're essentially tracking all this stuff already in the blockchain, and we also don't want to reinvent the wheel. So we've got a great partnership with them. They introduce us as to, in terms of like physical product owners, to want digital representation of the product and vice versa. So we've also got people who we're introducing them to as well.
So what I love about this model is that you take something that's very sort of Hollywood-centric, right? You're an animator, you're an artist, whether it's a short film or a Disney film, you get a job, right? But here you can create models, CGI models of the whole world that's basically sold through e-commerce, and you can get paid for it. And you don't have to actually work on that hour like you do for Disney today. You actually can have a prototype that gets sold over and over again, and you can get residual payments. It becomes a business. These are some of the coolest companies I've seen for creators, like in all these years of digital Hollywood. I think this was we started Infium, is we feel there's so many emerging technologies right now that are shifting, tectonically shifting the field of entertainment and many other industries, and we feel this is the time to help these kinds of companies get to that next level quickly. So Ben, when you digitize assets, can you explain the process behind it and why we need that today? These are clearly a good example.
Sure. Yeah. So I think I'm probably less in the field of entertainment, more on the financial services side. But I think some of the things that we had talked about before was on digitization, securitization, or tokenization. I think there are different terms people use, but really putting assets into tokens and having them be tradable and so forth. So just as an example, right now we're looking at tokenizing whiskey barrels so people can trade whiskey barrels and so forth. And the idea behind that really is more from having people gain access to a good investment product, being kind of the aging of whiskey, the increase in value as the whiskey sits in the barrel over time. And that, kind of using the tokenized technology, we're able to make that easily transferable among people, and that's one of the big advantages of using the blockchain technology.
Very fascinating stuff, and we may have the tokenized earth at some point. That said, I'm going to give some numbers that are not so great about the blockchain space itself, because I've done it for the last few years on these panels, so might as well do it today. So the total investment in 2014 is $0.6 billion. This was venture capital, pre-ICOs, right? And 109 deals. And then 2015, 137 deals, $500 million. 222 deals in 2016 with $0.6 billion. So not much going on, like about $500 million a year and 100 and change. And then in 2017, $1.4 billion in 487 deals. This is from Crunchbase News. And then in 2018, after the 2017 bubble, which we discussed here on the panel, back in 2017, there was 4.65 billion raised that year in 1,148 deals. And this is when everybody jumped in and said, oh, we're going to have a token attached to our deal and do an ICO or IEO in 2019. And back to only 445 deals and 2 billion year to date, 2019. So significant shrinking. Many different reasons. Some attorneys will argue it was a bubble that bursted and was promoted by a bunch of people trying to take advantage of the bubble. There are quite a few lawsuits of that kind. The SEC would say, they're selling securities and they were not filing them as securities, so they had their own lawsuits going on. So there are regulatory pressures, there are performance pressures, but aren't we putting the whole blockchain space on trial here without giving it any time to develop? Because the bubble really started, middle of 2017, so it's not like it's been around for more than, a couple of years. So what do you guys think? What is a good way to raise money if you have blockchain technology in your office today?
You first?
Yeah, you first on the hot seat.
There's a big difference between blockchain technology and essentially an ICO and token rates. So I think the two things definitely need to be separated. Cryptocurrency, yeah. In terms of identifying what the value is and what each one of them is potentially being used for. There's definitely a lot of value in terms of security through blockchain. So having some association with your technology with the security aspect of blockchain is definitely a credible story. But myself, like others, like last year when we were trying, especially summer last year, ICOs seemed like a viable way as an alternative to essentially, rather than giving away equity, was to try and do a ICO token raise and at least have something associated with that within your business. But that bubble burst literally as we were investigating that. We had a lot of advisors telling us about how to do white papers, how to what the value was. So did some time exploring that, but thankfully the bubble burst soon enough for us to not waste a lot of time, and then focus mainly on the technology aspect and the security, hence the transaction smart contracts aspect, and how that could then assist us with our story for fundraising.
Yeah, we did the same thing. So we spent a lot of time doing the exploration, probably more time than you did, unfortunately. And we had, the Perkins and Coie and Deloitte. We had all the big players, and then we had a bunch of other lawyers in the room, and nobody could decide on what we should do. What were the token economics? How are we going to make this work? And it was very difficult, and the regulatory, as just was changing every 5 seconds, and it was just really risky. And at the end of the day, we are a real business. We have a real product. We're solving real problems, and the blockchain is there to assist that. So it was more of that, and we said, okay, well, how do we go about this? And after the bubble, burst, we went back to basics, which is we looked at more traditional ways of raising capital, and we did that. And we did a seed round, raised a couple $1 million, and 1.5 in fiat and 500,000 in Bitcoin. And we're able to develop the product, and pre-launch, we've been able to have some serious strategic partners that also helped in us raising capital. So there's different ways that we went about it. And we also looked at crowdfunding and everything else, which we can talk about.
We'll put up with that. So Max, you did an equity raise the whole time, right?
Yeah, we like them. We also spent a lot of months designing a coin and doing the whole thing. And ultimately, because we were actually getting a lot of demand from our user base to launch a coin. We had tens of thousands of Ethereum people that were launch a coin, and we kept feeling one of the big things that they liked before that was that they were just earning Ether, they were earning a currency that was relatively well known, more well known than a lot of the other coins. And what I saw through some of my friends who did ICOs was that you don't realize until after you launch the ICO, but after the coin is up and running, you essentially need to run a monetary department. You need a whole separate company that just deals with all the different attacks your thing could get on exchanges, and tries to regulate the price. And so much of your company value is held in the coin, and so when the coin dips, it's like your whole company like totters. And the other big thing I think that we realized that ultimately was the reason we decided not to do it was that almost always in these projects the founders have equity in the company, and then they, additionally will probably also get some of the token of whatever gets launched. But in a lot of situations, the founders will be the only equity holders, and every investor will be a token holder. And so there'll be a lot of situations where whatever decisions potentially being made would maybe benefit the equity holder over the token holder, or the token holder over the equity holder. So it's not clear. It just misaligns all the incentives, and so people fight a lot. And yeah, I think I loved the idea of it. I still think it's more like philosophically pure or something, but I don't think it's ready yet. I feel like there'll be some sort of hybrid of equity and ICOs at some point when that's matured. But yeah, we also did an equity raise, and it seems to be the move as of right now.
Yeah, so Ben, you can maybe address kind of the global reason, because you've been in Asia, you've been here on a bunch of trading desks. Like, why did this even happen?
Yeah, I mean, I spent over a decade on the trading floor, and I've been kind of a regulated securities person in many different countries: the U.S., Japan, Hong Kong, Singapore, Taiwan, and so forth. So when I got in the blockchain space, which was probably later than most people, I didn't actually quite understand the whole issuing new tokens and so forth, in the sense that to me it felt like a brand new airline that is selling mileage of things that don't exist yet. It's like, well, how do you pre-sell that value? And that doesn't represent ownership of the company, exactly as Max his comment on, there's significant conflicts that are not resolved. I think the traditional financial world has set up kind of checks and balances on debt holders, equity holders, everybody kind of, knowing how they play, the order of when it gets liquidated, who owns what, and who has rights, who doesn't have rights. You get paid more for giving up rights, you get paid less, but maybe more upside for keeping your rights, and so forth. And the ISO thing was just, or you can get some electronic tokens and put money in, and hopefully you'll get something out of it, type of thing. And that was very uncomfortable for me. For most of our tokenization, for example, of whiskeys and so forth, they're basically whiskey being held by an entity, and the ownership of the entity is being put into tokens. The tokens are sold as securities, and they follow securities laws or proper exemptions that we file, U.S. and globally, and we offer them through that framework. So, I think for me that's a little bit easier. I think another analogy that I was giving to people is that I think when the railroads were invented, it was conceptually great. Everybody wanted railroads to go everywhere. So, to me, the kind of the ICO and the blockchain world, it's like everybody building their own railroads. And then all the projects are building their own rail trains on top of those railroads. And a lot of times you just want to be a passenger. You don't need to build your own rails, your own trains, just to get from point A to point B. Somebody's building that. Just figure out what you need and go with it. We actually, as a financial services company, are not spending that much effort on the technology side. We find partners. We try to find best-in-class service providers. We invest in those service providers, which is kind of a nice benefit of us being users. We talked to 10 different people. We realized which one we would use, and that would probably be a good investment for us, because hopefully other people who've done their research would come to the same conclusion. And we also don't have to worry about the back end of once it's issued, all the maintenance of it, which also Max mentioned, the economics of it. If they're considered securities, the whole concept of, hey, we should keep the token price up or down or any direction is probably illegal, right? So none of that, we need to deal with. So I think that there is kind of a fine line in that ICO raise space. With that said, I mean, to kind of give an objective view, internationally, certain countries are not taking that as far in the securities world. SEC's taken a pretty strong stance, and I feel like they took it a little too late. They kind of let the bubble build too large, and then they try to go burst it, so it's a little messy. And there are countries who have still continue. I think in Singapore, you can get a lawyer for $10,000 to write a letter that says it's a utility token, so now you have a utility token. then you can do kind of whatever you want because it's not a security. And that's a shortcut that I'm not saying you guys should take. I'm just simply saying that is happening right now, right? So it's tricky. It's a country dependent thing. It's the regulatory thing is quite tricky from region to region. So.
Yeah, so it's a jurisdiction really matters. Helen, you want to?
Yes, sorry, I'm like jumping at the bit. I agree. It was a bit early to call it a bubble and a burst, but I definitely agree it was an overreach. A sudden influx of all these products and arguably access to a huge class of investors with a lower level of sophistication. But fundamentally, the rules of raising capital are still the same. And I think you guys are really good examples of this. To drop in some stats that I learned on Tuesday at an esports panel here, average gamers are spending about $2,500 a year on games. Average music fans are spending $250 a year on music. And one of my own stats, people who make music, creators, musicians, take home 12% of that whole music industry income generation. So whenever I see a disruptive technology, specifically in blockchain, with my VC hat on, I think, well, who is incentivized to see this succeed and who is incentivized to see this fail? If you're trying to take that 12% and build and take from the rest of that market and disrupt that small bit of income, there's a huge amount of big players out there that are incentivized to see you fail. If you're creating a new market outside of the system, a new economy, those are the businesses that are going to attract investment, and those are the businesses I look at.
Yeah, it makes sense. I had a discussion with someone from New York who's creating a creators platform and connecting all the dots, because distribution and marketing and production and post-production, none of it is really connected for music, for film, TV, etc. And then I said to him, but what is the technology platform that you're using? Well, I don't think it really matters. I'm like, yeah, it really does matter, because otherwise you have many incumbents now with Apple and Amazon and everyone else jumping in or trying to kind of kill you off early on. Unless you have a breakthrough technology platform in this space, you don't really have a way to raise money. So what are some other ways that you guys have attempted to raise money outside of the blockchain space? Because that was kind of the theme this morning, is like you were there at the front line of these ICOs. Now, what are some other ways that you were kind of trying to do this that may or may not, may or may not have been successful?
Yeah, so, once the ICO, didn't happen, we went down the equity side of things. And we also explored crowdfunding. And there's a lot of different platforms that are out there. And it's really important that they do due diligence on you, but you really have to do due diligence on them. Because what they claim they have might not be everything that you're expecting. For example, how many people are accredited investors on the platform? What does that really mean? Have they verified them all? Have they all invested? Have they not invested? How many people do invest? Et cetera, is really important. And then what is their role in the crowdfunding? What do they do to help market you? Because this is all about marketing. Once you get on, you're on the site. How do they market you effectively? And do they also invest? And when do they jump in to invest? Because a lot of these platforms, they will invest if you hit a certain level, or they'll have a group of people that will invest if you get to a certain level. So there's all these questions that need to be asked. And, what are your responsibilities and how much is it going to cost you? Because there's that as well. Are they taking care of the, if it's non-accredited, are they doing the KYC? Are they doing all this, type of other legal side to things? Or do you have to pick up that? So these are all questions that you have to ask when you're looking at crowdfunding. The other thing is, what we learned is a lot of them expect you to bring investors to them. So you're bringing all the investors in, you're bringing in the lead, and so you have to understand where you are in the mix. And I find that, we found that with the blockchain and everything else in disruptive technologies, it didn't fare as well as those that are more the traditional. So you really have to kind of explore and see who is successful in your niche and where you are in that in that phase? Are you at the seed stage? Are you in a little bit later? Are you just trying to close out the rest of the round? You just need another couple $100,000. Where are you in that mix? And I think those are some of the things that we explored and looked at.
It's kind of interesting. If you look at Kickstarter and Indiegogo, non-equity bearing fundraising was very successful for entertainment and digital media for many years, and consumer products, right? And then when the equity crowdfunding started, first with the accredited investors like Crowdster and GoFundMe or whatever the platforms they are using now, and then with all of the equity bearing, Reg A and Reg C platforms, there's a real, I would say, difference the way you approach each raise. It's just fundamentally more complicated. We did a lot of Reg CF raises and some Reg A pluses, and you literally are spending 2 or 3 months producing more elaborate websites than you ever would in your entire life, and providing data in a public domain that you never have to provide even to the VCs in the meetings until you're like down the 7th, discussion on due diligence, right? So it really is a very challenging way to raise money, but yet what's really wonderful about it is the liquidity. So what are your views on, challenge versus having a liquid investment where people can go in and out of the investment and you can easily replace investors and you yourself can actually have exits along the way? Next.
Okay. Yeah, I think all those sort of crowdfunding structures are different. I feel like in terms of, you mentioned Kickstarter. I think Kickstarter, as far as I can tell, has largely just become like pre-ordering products. Like it's just like, which is cool, which is great as that exists. And I think these equity crowdfund things are also interesting. I'm coming from my experience of working with more like traditional VCs and funds and angels. I do think that there's a lot of, for an early stage company, there's a lot of, and I didn't necessarily realize this ahead of time, but when you get certain investors that are very strategic and that are like real people that you can like call up, all sorts of value really gets added on that sort of human level of like this person has decided to be an investor, this person like wants to do that as their job, they want to connect you, that is like, I would say almost over 50% of the value of getting an investment. So I think for projects that just need capital, like that's it, like they don't want to hear anything from anyone, they just need money, that could work well. But even for that, I think it's still a new structure, and I think there's so many more investors that are not on those platforms that are just doing the normal thing. And so I think you really got to weigh the money, but also like where the money's coming from and all the potential, you're giving away a few percent for however much amount of money, but you're also not getting on top of that all of the connections that could be made for you, or all the other things that you could get for that 2%. So you might get some liquidity, but you sort of lose some X factor of it being an actual human that you know.
And being so resource challenged at startups, it's not just money. It's really important to have what they call strategic money, and that money is what kind of value can they bring to you, whether it's connections to brands, whether it's connections to people, whether it's connections to other resources that are out there. It is just so other advisors that you might want to have to help you along the way, because in startups you're just going full force, and you don't have time to be thinking necessarily of all the strategic things that you should be thinking about, and so you need that help. And so it's not just about the money, which is what we want to.
Yeah, I think there are pros and cons for each of those platforms. We did a couple of crowd funds using Crowdcubes, an equity platform. And yes, the con is when you go out for your Series A, you are lacking the backing of your seed funders who would usually, spearhead your follow-on and be the strategic kind of cornerstone for all of your huge conversations. But for a company like ours, which is so community-focused, what it really did bring to the table was, just like you said, firstly, we did have to bring about 50% of our own strategic investors. So although we raised 1.8 mil or something, only half of that was actually crowdfunded, and the rest we brought in.
And they don't tell anybody that.
Well, yeah, you dig through the filings, and eventually it becomes
Eventually it's
obvious.
there, right?
But what was really great is that we got this really long tail of people throwing in a tenner, $50 here and there. But a lot of them were already within our community. They were people who are part of our London membership or our future US membership, and it made them feel super connected to the company because they're sharing in the future successes. So if you're running something that's more community focused, I think it's a really, really good way to have an extra connection with your customer.
And having been in the traditional venture model most of my career, I see so many issues with it as well. Okay, the first thing, like way back when we started the KPMG Accelerator, there was, it was the first accelerator at a Fortune 500 level where, we had 110,000 people globally that were professionals at KPMG going, okay, can we help your startups? It was really exciting, right? Lots of people to help and lots of value. But now there's accelerators just everywhere. There's a half a dozen of them with each Fortune 500, and there are many of them that are sort of privately held and global in nature as well. And what happens is that people get coddled into this idea that I could just have a business plan and a couple smart people and someone's going to give me 50 to 150 to maybe 250 grand to do something with it. And then you get to the Series A raises and it all falls apart because there's just so few things with an MVP that are actually having some traction from consumers, and all the VCs are saying, oh, we want all that. Additionally, the unicorn side of the things, which was kind of growing at a crazy rate for so long, right? And we had 1,000 unicorns a few years ago before the whole blockchain and crowdfunding started. They're all falling apart now. Like WeWork has kind of started the tsunami of unicorn debacles. So that model got to the point where the pendulum swung towards the investors in a big way. They were sort of controlling everything. Your deals, if you were a startup, to get even to an accelerator were expensive and very, very intense in terms of voting structures and rights that you have to your company. And then it got more progressively intensive to the unicorn level, if you got to the unicorn level. And then the set of expectations was we'll just all put our money into where we want to put it, and hopefully that will work, right? But it's not working. So I feel like there is a real dichotomy between the liquid markets, the crowdfunding, the blockchain, and the illiquid market, which is, when venture capital has become instead of 7 to 10 years, you're waiting 14, 15 years to see an ROI. What do you think may happen? I'm going to ask Ben to kind of put his analytical thinking cap here. What's going to happen here with liquidity?
Sure. I think the VC world is kind of facing the reality of if it's not a liquid market, then you can kind of market books pretty much anywhere, and that was kind of what was happening with WeWork. But when you're ready to go to do an IPO, they ended up writing out on paper all that they're doing, all that they're planning to do, and then you read the paper, and I don't think anybody was impressed, and that was kind of how the whole thing started to get unwound. I think that there are markets developing for private, what is the right way to say, pre-IPO shares that are being traded. That's always kind of been in existence. And with the application of blockchain technology, there is an increase in liquidity of a lot of these things. So I think it's not as rigid as before. Before it was really, until you have an exit, you just have to hold on to it and you run 10, 15 years. And on the flip side, people just don't go do IPOs. They just sit on and kind of continue to grow and making further and further and further rounds. I think people are going to ask for more public disclosure, going to ask for quicker IPOs, and also I think there will be more trading on the back end of that. So I think that part of it is good. Overall, I think this whole kind of increase in people's involvements in investments and startups and so forth really is driven by the fact that there's probably too much liquidity in the market, and that's more of a kind of a macro statement. I think people do have excess capital around that they want to invest, even not and they ended up either investing in themselves or in the investment VC companies who end up having big VC funds and so forth. You're seeing outsized funds being raised at VC, in real estate funds, in pretty much every single asset class. People are just buying it up because, kind of more paper or more zeros are available now. So I think that's what's driving a lot of this, actually.
So the liquidity will be continuing to happen.
I think the liquidity will actually increase, but with that increase in liquidity, there is a day of reckoning for companies that are not really making money for that valuation to hold and things of that nature. At the end of the day, the whole discussion of driving growth is at some point you're going to make money and you're going to get that money back. So, that's kind of a fundamental reality that when we went through kind of Internet 1.0 back when I was going to school, that people left school early just because they didn't want to miss the rush. They went and they built, and people were trying to measure their business by number of eyeballs. You can't deposit eyeballs, you can't withdraw eyeballs, you can't spend eyeballs. They're just eyeballs. So that monetization for certain people, that didn't happen, and those companies failed. And their business model, they were successful. I mean, Amazon went through all of that, and they're successful because they had a lot of revenue other than just eyeballs. So I do think that day of reckoning will come on, and it's slowly transitioning, right? Is that actually going to make money? WeWork fundamentally doesn't make money, and it takes on a lot of long-dated real estate risk by selling short-dated real estate revenue, and that long versus short mismatch doesn't work fundamentally as a model for them. So, they're a lot more flamboyant than all the other real estate companies, because all the other real estate companies were actually, traditional ones are operating on models where they say, I can't take that risk. I don't know what to do with that. And WeWork was filling it with VC money to say, don't worry about it, we'll cover it. I'll just go raise another round if I have revenue shortfall. So they keep burning through money. And at some point, you have to pay the piper. So,
Yeah, Matt.
I just want to, push back a little thing on that. Was just, Amazon doesn't make money off eyeballs, but Google, Facebook, YouTube, it's all eyeballs. And so I think if you know how to monetize the eyeballs, I think then you really win. And just as another side note, we were talking about accelerators earlier, and one of the things that I've found that I didn't know before raising money was that, because we got approached by a lot of accelerators at the beginning, and we were considering doing one, and one of the things we heard multiple times was that if you don't do Y Combinator, if you don't do like Techstars, if you don't do one of the top accelerators, then it actually is seen as a really bad thing if you do any other one, because it's seen as like, you couldn't. It's seen as like a negative flag that they would like for a later round, that you might sort of highlight you as not a very promising team or might not a very promising company. So I just want to throw out there, because I didn't know that as a sort of a landmine to walk around, but I'd say that in practice, that's like a thing.
That's so funny you bring that up. When we started our accelerator, the whole pitch was, you don't want a deal. You want a deal on the way to Kleiner, but once it's at Kleiner, you're not going to get the deal. And once it's out of Kleiner, you don't want it. So it's kind of like you have to get in between that entry into Kleiner's portfolio, right? And it's the same idea now with just the lower down the scale Y Combinator, and you see how more challenging it is to make a good decision as an investor whether that deal is going to make it or not after 17 pivots, right? You wanted to say something?
Not really.
Always.
You've seen it all.
No, I think the main thing is with anything when you're trying to raise money, ultimately the ultimate goal is to generate revenue. You're creating a business. The scenarios where you're trying to raise money and there's no real business. It's the potential of technology, the potential of something. It's like, yes, there is investment there, but it's really hard to convince somebody in terms of unless you've got real traction, or you've got either advisors or you've got some sort of strategic partner that can say, look, this is like a possibility. So you've got somebody bolstering your vision. But what we found essentially this last year was the best way to go out and raise money is actually have a business that's generating revenue. Then you've got traction. You can show that the money is essentially going to scale your business, and how you're going to do that with marketing, etc.
So that's what I love about this panel. It's all about that. I want to ask audience, we have 10 minutes left, if you have any questions for our panelists. Yes, go ahead.
Hi, my name is John Q. You call me Q, like the letter. I believe we're at a very interesting intersection right now with film tech, media tech, and I guess blockchain, right? Our organization is called TILFA, and we're connecting all the film markets in the world on an artificial intelligence blockchain platform. Now, when we approach financiers, either in the VC industry, they're skeptical about blockchain and crypto, and our platform doesn't use cryptocurrency, but it automatically assesses that what you're doing is tied to crypto, so they kind of don't understand it, so they're hesitant. But when we also approach film financiers, they're like, well, we're not in the blockchain crypto industry as well. So it's like, I know that there's a strong need for this now, primarily with what we're doing to manage DRMs. What is your advice on how do you approach to raising capital in this industry, primarily the film industry, with this blockchain type of a platform that's not utilizing cryptocurrency?
So is it public blockchain or private blockchain that you're running?
It's going to be on a public blockchain.
I wouldn't make a big deal of it, honestly. I would talk about your core value as a company, and then I would say, like, as a side note, like, oh, the way in which we make sure everything, you know, stays secure is like we post it as a transaction on a blockchain. But I wouldn't frame it as if you're like a crypto company. I think that just generally hurts nowadays. And so I would sort of keep it as like part of your tech stack, but I wouldn't shout about it.
And that's what we did as well. We originally we came out, we're like, oh, blockchain, that's, you know, because it was all the hot thing, and then all of a sudden it was like, you know, a dirty word. And so we had to kind of take it out of our presentations and know that it's in our tech stack is right. You know, how do you do all these amazing scalable things? And oh, well, that's the blockchain. So we kind of keep it on the side, knowing that that's in our bailiwick. But what we are is a core business that helps people and we solve problems. And that's what you have to pitch. This is how we do it. This is how we drive revenues. And you pitch all of that piece of it. And that's how
you
we've
need
done
a
it.
minimum viable product. At
That's
this
right.
point. So I don't know if you have that. It seems like it's going to be on a token. It's like not a good thing to say to investors right now. It's like, here's the platform. Here's an uptake on it. We got, 10 film festivals signed up and they're using it and it's working great. Then you'll get an investment today versus like a white paper when we put this on ERC20 or what, it's not really, we're in a different market.
And I think all the investors really are just going down the same traditional thought process, which is you have to have a viable product, you have to have proof of concept, you have to have revenues, other people that are buying into it so it's less risk for them. And if you can solve all of that, that's what you're trying to address. And so you just address it from a traditional perspective. And that's how we have found that has worked, because otherwise if you go down this path, you end up answering all these questions about giving a education on what blockchain is. Then you've become now the teacher, and that's not really what you're trying to accomplish. At least that's what we had found.
Quickest path to the accomplishment.
Yeah.
Good question. Any other questions? Yes.
Hi, my name's Anna. I'm curious about Max's comment regarding, applying to accelerators, and unless it's one of the top ones, like, don't bother applying at all, almost. As I'm part of a startup right now that is in that process of trying to apply to accelerators. I'm curious what the rest of you guys think regarding that.
Yeah, I can jump into this. When I was at Lazard, we spent a long time deciding whether or not we were going to start an incubator. So I went around every other company in town and who had started an incubator and talked about why they'd done it. And I'd say more than 50% were funding it out of their marketing budget, which means they're not really interested in the outcome of the companies attached. It's a way for them to be publicly involved in innovation and the new generation, but the standards of entry are pretty low. So I think it's not that you can only go to those two accelerators, but just make sure you do your research and make sure you're getting into something where they are incentivized to see you succeed rather than put your logo on their website as a PR exercise.
Yeah, and I also just want to say, in doing the research is really an important piece of it, but not, the Y2 Combinators, all those different, accelerators that are out there can only handle a certain amount of, companies that they can support in a given year. I mean, you're one of a very select few, so you have to look at alternatives. And what you look at is what else they can bring to the table, not only through the whole process, and not only through the process, but afterwards. What else can they bring to you? Maybe it's accounting services or legal or whatever it is that you may need, because again, we talk about resource challenge, you are, and so what are the resources they can provide to you? I'm not so sure if I'm on the same wavelength of that it's a negative. I actually think if you can be successful in any accelerator that shows success, to me that's like getting money from an angel investor. Thank you, right? I mean, like, to me, I think it's a positive thing. If again you're doing the research and you're finding the right ones that can help you along the way.
I just want to back up my statement a little bit. So this is what I was told by people. So I was told by people that, if you go to that one, like, we wouldn't even look at you if you were in that. So that was I'm giving you just the data of what I heard. But I do think in general, I would say on average, a lower end accelerator is easier to get an investment from than sort of an independent angel. And I think in a certain way, seeing for your company's sake, if you could raise money from angels, that's a good data point to know. Like, if you can't, then there might be something that you still need to work out, and that if you worked out before you raised money, it might make the valuation a lot different. And so, I mean, it depends on your situation, but I think trying to hold yourself to the highest bar makes all the future funding much easier.
And you just check their track record on helping the companies raise Series A after they graduated from the accelerator, and how many of those, if they've been around for a while, have actually exited successfully, had like an IPO or some other liquidity event, through M&A, et cetera. So those are the two statistics. Last question. No more questions? Okay, one more. Hi.
I was wondering, I see the kind of time about a year ago. Is ICO coupled with IO? Is that a viable solution?
It's still happening. There's about a couple billion raised this year through ICOs in the blockchain space. Many different jurisdictions have different regulation. When I went to Malta in 2018 for the conference, 8,500 people showed up, which is the largest the Malta Blockchain Summit was ever been. And the reason for that was that Malta passed the regulation for digital financial assets at that point, and would allow ICOs and IEOs. They're legal in that jurisdiction. Switzerland has pretty good laws for that. Singapore, now Bermuda's trying to become the central location for all of those. So if the companies are in the jurisdictions where IEOs and ICOs are being validated by the regulation, they're still happening. In the U.S., we had the SEC sue companies that are not even from the U.S., but Canadian companies that are in. So not really. You would have to be in another jurisdiction. Yeah. To do the raise, I think you would have to have the whole company function in another jurisdiction. Yeah, they are happening. So it's about $2 billion raised this year.
Does it still raise money?
It has. It's a couple billion this year. Yeah.
It's smaller.
Yeah, it was like at $12 billion last year. So big. I mean, it's declining. Yeah. So we're just talking about the big trends, and that trend's declining, but it's still around.
Yeah,
there's a problem with the liquidity of all the tokens afterwards. That's what people are realizing.
I'll jump in with probably two comments. One is, in terms of size of raises, I think that's more a reflection of people's appetite for it. And that comes from the fact that, crypto hasn't done well overall as a market from an investment perspective. In 2017, whatever you bought went up and everybody was buying, and that new capital flowing in, it was easy to raise a lot of money. It's much harder with the bulk of those existing investors already sitting on major losses or write-offs and so forth. So that's one part of it. And just to answer the specific question you were asking about IEOs and ICOs, I think IEO, people are buying it. So just for those of you who are less familiar, IEOs are basically ICOs, except they kind of have a stamp of approval from the exchange that they're going to be listed on. And the exchange is de facto making a review and an approval of that deal because they're going to list it on their exchange upon the successful IEO. And they get paid for that, obviously, so it's a little bit of a conflicted discussion. So overall, that's kind of the major difference there. But from a regulatory perspective, all of the discussion we've had with regards to ICO also applies to IEOs. The legality and all that just really doesn't change just because some business, being an exchange, give you a rubber stamp of approval. So.
We can actually help
exchanges, like a few hundred of them, and actually I sit on the advisory board of S9, which is a system that's kind of creating more liquid marketplace globally. And once you start looking at the issues with the exchanges being unregulated and developed as they developed, look at what year, a couple of years time, it's very hard to gauge how your business is going to actually grow with a token. So yes, you can raise the money, and then what? We didn't even talk about this whole dichotomy. After looking at a couple hundred companies, I launched something called Bid Angels, and we had all the original investors in top 200 companies and 40% of the market cap of crypto, and you meet with all of them. There are some really solid businesses, and their tokens were just, the value was down, 95, 97%. There was no reason why these companies should have their value, their token value down to that extent. And so it was very hard to manage the business and grow it through all these things that they're describing and manage the growth of the token in a market that's completely deregulated and completely, being a math major, arbitrary. It's not like there's like these bunch of exchanges and you can market make. People are trying to market make across exchanges that are not having any sort of logic underneath it. How do you market make across that? It's just not possible, right? Is that what you're trying to say?
Yeah, I mean, I think you mentioned, there are many, many exchanges out there, and I agree with that. But I think you can build an exchange. So the question then comes down to how many real users you have on there and so forth. And everybody wants a Binance, IEO, and people get in line for that. People pay a lot for that. They're you fighting over who can have an allocation for that versus much smaller exchanges who would be able to do your IEO for very cheap. And this goes back to I think Mariana's point of what happens after you do the IEO. What happens to the token? Does are investors even interested in doing that, or are they just there to buy the IEO so they can just dump it the moment they get it? So it's not an interesting. It's a very tough environment from that perspective, and part of it has to do with the fact that it's not really regulated. So people are really acting out on their own interest, and a lot of that is very short term rather than how well the company they're investing in will do.
I just want 1 minute from each panelist to if you were sitting in this room trying to fund your company, what is one takeaway you want to give them today? Okay, start with Max. You've got all the great ideas. You're first.
I would say meet the smartest people you can and have really good conversations with them and entertain them, and be kind of selective and kind of be the person that's choosing them. That helps a lot. And just don't take any money that gets thrown at you. If you're selective, then it kind of sets the tone and things tend to go well.
Helen?
Yeah, I've been sitting here listening to all this and thinking a lot about the democratization of access at the really early stages, and that's something we see across pretty much all industries at the moment. And I know I keep banging on about the music industry, but that's where my brain's at. So just like there's 26,000 new songs on Spotify every day, there's hundreds and hundreds of new startups setting up every month. And just because it's become a lot more easy to get into that first stage, and ICOs have been a big part of that, and that the amount of capital that was accessible, doesn't mean that standards have changed to get your Series A. And the standards are still pretty hung on financial metrics. That's kind of what we were talking about. The financial metrics need to be solid. You can't raise money on hype. You can't raise money on attention, eyeballs. You can monetize. So as boring as it is, I would say, your financial metrics have just got to be so solid. Otherwise, you're never going to get into the Series A world, and you're never going to be able to scale.
Yeah, I think one of the things, I think probably my one point of advice to all of this is that you should really look at yourself and understand where your firm is at in the grand scheme of things. I think there's always a big mismatch sometimes when very small firms end up seeing the biggest VCs, they have a connection, they get a meeting, and some of the VCs aren't really able to invest in some of these projects. So you're really finding the right client base to go to with whatever project you're working on, I think is actually a very difficult thing, but that's something that you should try to do. And the better the fit is, the easier that conversation is. And sometimes it may be slightly above that chain or slightly below that chain would really help move things along.
So I agree with that. I think one of the most important things you need to do is make sure that you're checking all the boxes on what, if you're going to a VC or any investor is going to ask. First of all, are you solving a problem, right? And will people want to buy or purchase anything that you're doing? Do you have the right team that can execute your plan? Do you have a business plan? You make sure you have a plan that actually shows how you're going to get there. And more importantly is, what is your go-to-market strategy? Because the go-to-market strategy is how you're going to execute and be successful, and how they're going to then get to that exit and get there faster. So you have to be able to answer all of these questions. Getting in front of the right people is so important. So you need to strategize on, which are the right, if it's VCs, which are the right VCs that are in my space that have invested in maybe competitors, because they'll understand it. And why is that important? Because not only will they invest in you, but they understand how to help you. So you have to look at all of these different things, I think, before you take the first walk out the door to figure out what that is.
Back to the basics.
That's right.
And then ultimately, there's differentiation. Why are you different than anybody else? Why is your product better than anybody else's? And what are you going to do with your team that somebody else can't do? And that gets back to like how you market yourself, even when you're going in to meet these people. And then ultimately, what's your marketing plan once you've created this amazing product? And how can those people you're talking to actually help you get there?
Yeah, this is really an amazing panel. I want to thank everyone. We're launching Infium Salon tonight. Wait a minute, you get a free pass. If you talk to me, I'll give you a free pass to come. It's in Santa Monica at Spaces. You can see you on and Max present as if they're presenting to the investors, which will be in the room, but you guys are invited. And we also have another panel at 12:30. Thank you so much for being wonderful audience, and thanks for clapping. And we'll take outside for all the questions.
I'm going to have to send you an email. I don't know if I've read it.
Extra time.
But I'd love to.
Just walk
Thank you.
outside.